Afternoon, ladies and gentlemen. After a hugely successful webinar on Tuesday on the role of international financial centers in sustainable investing, we are very pleased to invite you to our second webinar in the World Investor Week on the responsibility of the investment profession towards sustainability. I have great pleasure in introducing my panel here. We have some fairly eminent people in this domain. I would start with Mr. Amit Tandon. He's the founder and managing director of IiAS, India's largest and well-established proxy advisory firm that provides participants in the Indian market with independent research and data on governance and ESG issues, as well as voting recommendations on shareholder resolutions for about 800 companies, representing over 95% of India's market cap. Prior to being in IiAS, Amit was the managing director of Fitch Ratings until June 2011, where he was responsible for its Indian and Sri Lankan businesses. While at Fitch, he was closely associated with the development of the debt market. And prior to Fitch, he was an SVP and head of corporate banking at ICICI Securities, responsible for the capital markets, both debt and equity, M&A, and advisory business. Amit has a bachelor's in economics from St. Stephen's, an MBA from FMS Delhi, and an MPhil in economics from Cambridge. Welcome, Amit.
Good afternoon.
I would next introduce Paul, Mr. Paul Smith. He is the founding partner at SustainFinance, a non-profit thought leadership platform focused on purposeful finance and sustainability. Prior to founding SustainFinance, Paul was the president and CEO of the CFA Institute. Paul has over 30 years of leadership experience in the asset management industry, including about 18 years in Asia. He joined the Bank of Bermuda in Hong Kong as Asia Head of Securities Services in 1996. After HSBC's acquisition of the bank in 2004, he served as the Global Head of Securities Services and the Global Head of Alternative Funds Administration in New York, where he was responsible for the delivery of services to over 2,000 investment funds with over 250 billion of assets. Before joining the CFA Institute in October 2012 as Managing Director for Asia Pacific, Paul was Chairman and CEO of the Asia Alternative Asset Partners. Paul is a member of the Honorary Advisor Panel of the Financial Reporting Council of Hong Kong and a member of the Product Advisory Committee of Hong Kong Securities and Futures Commission. Paul holds a master's degree in history from Oxford University. You're very welcome, Paul. I would next go to Ms. Pavoni. We have Ms. Silvia Pavoni. She's the editor of Sustainable Views, a newsletter by FT Specialist, a division of Financial Times, and the economics editor of The Banker, also part of the FT group, for which she created and writes the Better Banking column on sustainable finance. Since joining the Financial Times in 2005, Silvia has been on assignment to over 2,000 countries, reporting with both written and film pieces. Previously, she was in charge of Centaur Media's specialist database on public-private partnerships, which was tasked with providing data to the UK government. Silvia is also an advisory board member of the European Risk Management Council, a member of the London Council for Not-for-Profit WILL, which is Women in Leadership in Latin America, and an honorary fellow at the City University of London. Silvia holds an MSc and a BSc in Economics and Finance from Ca' Foscari University of Venice. And last but certainly not the least, may I introduce our moderator, Mr. Vidhu Shekhar. Vidhu is the former country head at the CFA Institute in India, where he was responsible for advancing the mission of the CFA Institute and supporting the CFA chart holders across India. Mr. Shekhar is a seasoned finance and investment professional with over 30 years of industry experience in India and abroad. Previously, he was Vice President, New Products and Business Excellence at the National Stock Exchange of India, overseeing new product initiatives in debt and equity markets. Prior to joining NSE, he was Senior Vice President at IDBI Capital. Vidhu has a bachelor's degree in physics from the University of Delhi and an MBA from IIM Ahmedabad. I am Tithankar Patnaik. I head research at the National Stock Exchange, and it's my great pleasure to pass the baton on to Mr. Shekhar for the discussion. Over to you, Vidhu.
Thank you so much, Tithankar. Welcome to all of those who have joined us live. And it's wonderful to be here with friends, old friends, and Silvia, whom I'm meeting for the first time, but whose column I have been reading on the Financial Times. So it's great to have this conversation. about about sustainability in the context of the investment industry and the investment profession. So, I'm assuming that most of you are, you read the business papers, you're familiar with the ideas, and you deal with some sort of sustainability issues in your professional lives, but you may not be experts, because sustainability is such a vast and broad field, and so much is changing every day that it's very hard to get a handle on, on everything. So today, our attempt in this panel would be to look at sustainable finance in the context of the broader sustainability issues, and how the investment profession and the investment industry is responding to the challenges. What are the responsibilities of the profession, and what are the responsibilities of people working in the industry as individuals and leaders of firms? So, it is as we know, there is no bigger problem than sustainability that is facing us, and it's not just climate change. Climate change is the big problem that gets most attention, but we also have other issues like resource depletion, waste, pollution, loss of biodiversity, and so on. And we are at a stage of economic growth and resource utilization in this world, where this has become a challenge for the planet as a whole. In the old days, when human beings were hunter-gatherers, once they had finished hunting all the woolly mammoths in one area, they could move off somewhere else and find some other animals to hunt or do something else. But right now, we seem to have mastered technology so much that there aren't any more new avenues for us to explore, and we've become very good at exploiting whatever resources we have. So what we will do is this panel. We will have two parts of this panel. In the first part, we will go over some practical issues, the landscape, and since we have people who have expertise in different regions of the world, we will bring up the issues in the context of those regions. I'll first go to Silvia, and I think everybody knows everything, but just I'll ask Silvia to focus on Europe and perhaps Asia as regions. As you know, when we talk about sustainability and sustainable finance, we have to discuss issues again about standards and disclosures, what the regulators are doing, and how the industry itself has been responding. So I'll ask you, Silvia, to spend 5 to 7 minutes, and we will go around the table, do the same thing with Paul and Amit, and then we'll come back and pick up the issues one by one.
Sure. Thank you, and pleasure to be here. Thank you again so much for inviting me. So shall I share a few words just to explain the angle from which I look at sustainability and ESG, this clumsy term that groups together environmental, social, and governance factors. So I'm a journalist with the Financial Times Group, and Sustainable Views, which you heard started as a newsletter, now has become a website, a title, and we're building out other different services. And the focus is on policy and regulation. The focus is on this area because we discovered, I as a journalist and the team working with me, as we were researching further this subject for expanding on the existing newsletter. The reason why we focus on policy and regulation is because it is the one thing that whether investors, companies, consumers even, believe or not in the importance of sustainability and the broader concept, I'm sure you're very well familiar with another term that may make you feel little bit cringy because it's associated to, it's a bit of a clumsy definition, but moving from shareholder capitalism to stakeholder capitalism, whether you believe in the merits of this or not, if the regulator does believe it is important to monitor what investors, what banks, what companies do, then everyone must pay attention. And so that's an area that we focus on. And certainly in Europe, I'm based in London, in the UK, and we look at what happens in the UK, and we look at what happens in Europe and in other parts of the world But Europe certainly has provided quite a lot of regulation, quite a lot of activity around sustainable finance. Again, the alphabet soup of sustainability is ever growing and ever bubbling and confusing. And so we have SFDR, so the Sustainable Finance Disclosure Regulation. We have CSRD, which is the EU proposal that would require companies to disclose their sustainability factors. We have a variety of reporting frameworks, from TCFD to SASB, to the work of the ISSB, to different organizations looking at finance and net zero asset owner alliance, G funds, EFRAG. So it's a really confusing and complex space. But again, at the core of it, we're talking about what is driving it and what investors should do about it, or should respond to all this talk and regulatory action. Well, a lot of it is actually driven by investors, because in addition to the ones that are firmly committed to investing only in companies that have a positive outcome on the environment and on people, so the so-called impact investors, you also have others, and a growing number of investors, asset managers, but also asset owners, pension funds, insurance companies, that look at ESG as a risk factor. So they want to know whether a company that's a textile company, so not even before going to the energy companies, the fossil fuel producers, let's say a textile company, which kind of textiles does it use for the end products and the supply chain? Is the textile created using, abusing human rights, perhaps? What are the responsibilities of ultimately the company at the head of the supply chain? So a lot of investors are already asking companies to provide this information. On top of this, the regulators are also taking steps to do so. And so whether you are based in the EU again and you're captured by those regulations, or whether you're based elsewhere but you're part of the supply chain headed up by a company based in the EU, then certainly you are going to be asked about your ESG data. And it's difficult, isn't it? Because, I mean, no one was really capturing that information in an organized way. And the definitions varies. So one piece of regulation that has come out of Europe, and now that over 20 other proposals around the world, is that of, again, the taxonomy. So defining this language of ESG, defining what is green. And I like to talk about ESG as a language. We're not proficient in it. We are learning, right? It's an ever developing language. There is a cacophony. A part of this ESG, all this, again, clumsy abbreviation, overlapping of terms, and the regulators essentially are dictating the grammar of this language. It's a tough challenge, but certainly a challenge, and I don't want to take up too much time. I know we're talking earlier that we're not going to be short of comments to make. We're probably going to get to the end of the session with still a lot to talk about, and I tend to be quite chatty about it, but it's so I don't want to steal too much time. But just to wrap up, it is an area, again, that's very few people, I think now that they can not look at, whether because their peers are looking at this area and asking companies about this and preparing for these risks, or whether because the regulator will make it impossible for them to ignore those factors. The challenge now is to define these factors, really, to work with the policymakers to ensure that the frameworks that they are creating for disclosing the information that you as investors, as asset managers, as pension funds want to have and need to have, and to ensure that ultimately this doesn't end up becoming a box-ticking exercise, so that, oh, we've done the ESG report, that's fine, but that's all these efforts actually point towards creating companies and financial markets that are more sustainable in the original sense of the word.
Thanks, Sylvia. We'll come back to some of these issues, once, I've gone to Paul and Amit, but I want to go to Paul right now. And Paul, I would like you to tell us a bit about your motivations for working in this area, which you have started doing in the last 2-3 years. And also talk about what's really happening in our part of the world, because until recently, most of the emissions were happening in the developed world, right? 70%. But now that is changing. China has emerged as the largest, not just largest in terms of carbon emissions, but also the largest in terms of the green loan market, and second largest for the green bonds market, and so on. And there's a lot of activity happening in the rest of the region, including ASEAN and India and so on. So if you can just give us a perspective from the APAC region with specific focus on China.
Thanks, Vidhu. Great to be here. Thank you to Tirthankar and to the NSE for inviting me. It's wonderful to be part of this. Yeah, I mean, what motivated me? I suppose I'm an asset manager by trade, and when you look at the challenges that our industry faces going forward, ESG is perhaps the biggest opportunity that we have, Vidhu, and I think that's something that asset managers have been slow to understand, that ESG is a huge opportunity for them in terms of recreating our profession, if you like. When you discuss ESG with asset managers, most of what you get back is the data's very poor, regulation isn't quite there, we can't do this, we can't do that. 1,000,001 reasons why they can't do anything, rather than look at it slightly differently, which is to say, it's good that the data is poor. Because the data is poor, I can actually add some value as a human. I can do some work. I can go into a company and I can investigate what its emissions are. I can look at its supply chain. I can ask questions that other people haven't asked before, and I can uncover proprietary information that I can then use for my own models and for my own investment purposes. The problem in asset management, as you and I know extremely well, is that mainstream asset management is essentially computerized, and there isn't a huge amount of space for human judgment and for us to apply the skills that we've laboriously learned over the years. And I think ESG is the one area of asset management that really offers us that solution. So that was really the prime motivation for me of getting involved in the sustainability area. I also think, and I think Silvia really touched upon this, that it's the construct of this conference, the responsibilities of asset management towards ESG. I don't know that asset managers particularly have any greater responsibility than any other actor in society. I'm not sure that that's true. The asset managers are fiduciaries, and they will do what their clients tell them, as Silvia correctly pointed out, and they will do what regulators tell them, and they will do precisely those things. But they're not going to go off piste and start creating products and start investing assets that their clients and regulators don't want them to do. So I think it's important to say that asset management is a derivative. It's not going to be the main motivator or the main mover behind solving the world's challenges in sustainability. It's going to be the prime tool, but society has to learn how to wield that tool better than it does at the moment. And I think governments have been particularly lax, in my view, in terms of trying to push asset management in the right direction. They've tended to sort of sit back and say, well, why aren't you doing more? And that's not just for asset managers, for banks, that's for other financial actors as well. And the reality is that all of these players will play the game that's in front of them rather than the game that isn't. And I think that's an important message that we need to take as far as regulators are concerned. Second main thing before I turn to APAC, Vidhu, and I promise you I will, is that sustainability, I think two things to say. Sustainability is much more than the environment. Sustainability is also about the social and the governance aspect of the ESG world. And then linking up to that, sustainability looks very different if you're having this conversation in the US to if you're having this conversation in the EU, if you're having this conversation in Asia. By and large, in Asia, and it's a gross generalization, sustainability does come down to environmental concerns. In the part of the world where I sit, I'm talking to you from Hong Kong today, which is my home. From this part of the world, from China and from other major players in Asia, really it's environmental governance. We are, again, a generalization, pretty poor at and not getting any better at, in my view. We tend in Asia to have family dominated companies where there are independent director provisions. Independent directors tend to be friends of the family rather than genuinely independent. So governance is still, and I'd be very interested in Amit's comments on that. Governance tends to be something that's honored in the breach rather than anything else. And social issues, obviously, are a real challenge for us in Asia because we are, by and large, developing countries trying to develop, and that social construct is often quite difficult, I think, within that environment. I often think the S of ESG is a luxury good rather than anything else. And I think one of the areas that we're not touching on today is Africa, for instance, which is going to provide the bulk of the world's young people over the next 30 years and has been responsible historically for about 3% of greenhouse gas emissions. And the weight of expectation that is coming onto African countries to do something about future ESG emissions or environmental emissions is completely disproportionate to their responsibility for the crime, basically. And I think these things are challenges that the world really has to face going forward. Turning to China, China specifically, Vidhu is really at the forefront, I think, of the environmental challenge. It has the most aggressive of all countries' carbon emissions reduction targets. It's created a taxonomy that now sits alongside the EU. I think they came out with the EU-China Common Ground Taxonomy, rather clunky phrase, a few months ago. It's adding renewable energies faster than anywhere else in the world in terms of kilowatt hours. And its green bond issuances, I think you mentioned in your intro, is far and away larger than any other country out there. We now have in China something like, in the last 20 months, something like, I think Bloomberg reported, 120 new ESG funds that have been launched with about $50 billion of assets within them. It's ESG funds China style. It's not necessarily as Silvia might recognize them in the EU, for instance. They have a lot of coal in them. They have a lot of steel in them. It's more about, as far as ESG in China is concerned, it's intentional. It's how you move. It's much more practical, if you like. It's about the transition economy. How do you move from where we are to where we want to get to? So you can be an ESG fund in China and invest in a coal producer, provided that coal producer is trying to green its production over time, basically. But that's kind of where the thinking is in China at the moment. And obviously they have some great electric car companies, battery companies, solar power, wind power. All of those technologies in China are very well developed and very well advanced. So there's lots of opportunity in pure economic terms as well. ESG funds really are aligned with government initiatives. 2060 net zero is the government initiative. Energy security, rural employment, and poverty alleviation are really the things that make you an ESG fund in China. There are disclosure rules for all Chinese listed companies as far as ESG is concerned, and that's really the direction that the asset management companies cue off. It's patchy in terms of the quality of that, but it is improving, and it's it's a sort of a watch this space area that little by little, year by year, gets better and better. The rest of Asia, Hong Kong, is partly because our head of our Securities Commission here is also the chairman of IOSCO. We've been very quick to produce good legislation forcing managers from last year, in fact, to disclose ESG risk measures within their funds and to publish those and to really comply and explain why their products are not following the SFC's, our Securities Commissions here, ESG guidelines. So that's something that's being implemented, large managers first this year, smaller managers going forward, but it covers everyone from hedge funds all the way through to major pension plans. So a lot of thought going into describing your risk management techniques around climate change. Those all now have to be in your product prospectuses and in your general corporate literature as you go forward. Singapore, it's guidance only for companies at this stage, nothing more than that. It's guidance for companies and for asset managers. There's nothing mandatory. Japan is moving into the mandatory world. Tokyo Stock Exchange listed companies, the prime ones now from 2022-23, I think, have to have mandatory ESG reporting. Nothing as far as the asset management industry is concerned, but companies are being forced to finally disclose. And Australia, surprisingly, given the focus that they have on the environment in general, has as yet not moved towards any of these disclosure regimes at all, although there's a lot of conversation around that, and with the change of the government from the sort of slightly right-wing to now more left-wing government in Australia, I think mandatory disclosure for corporations in terms of their ESG policies is coming. But obviously, given the reliance of Australia on the extractive mining industries, it's a very difficult subject for them to cope with. So Asia in general, I think, is moving in the right direction and moving quite quickly in the right direction, but it's a long road to travel, and obviously the vast bulk of Asia is still a developing market as opposed to a developed market, and so we have a lot of challenges along the way. So I'll end out there.
Thanks. Thank you, Paul. You covered a lot of ground, and again, I will come back to some of these issues. Amit, with you, there are two things that I want you to do for us. One is, of course, talk about India and what's happening in India. And when I was listening to Paul, I felt that the Indian regulator is ahead of Australia, for instance, in terms of some of the regulations. But also, you are in this panel, you are the one who has the closest eye on companies. Okay, so what's really happening at the company level? What is it that is driving their decision making? From what I observe, people started taking sustainability and ESG seriously when the large foreign portfolio investors started asking them. Can you talk a little bit about how the larger and more important firms embarked on their sustainability journey, what they are doing, and then also discuss the regulatory landscape in India? You're muted.
Thanks. Those were two very comprehensive overviews with regard to what's happening. And I'll kind of add some color with regard to what's happening in India. I will say the first thing is that for the last few years, I've not had a conversation with a company or with a fund manager where they've actually not discussed what is happening in this whole universe with regard to ESG or sustainability or stewardship. So therefore, it is something which is uppermost in their mind. It's also very clear when you talk to them that they know that they need to do something, whether it's a corporate or whether it is a fund, but they're really not sure how they should move forward. So I guess the way I've kind of started describing it is that they're all circling, waiting to land, but they're kind of waiting for, to see where the landing lights are. And in that sense, I expect that it's the onus of the regulators, just given the amount of discussion and discourse and the lack of clarity, that I'm hoping it's the regulators who are going to show us what the runway is, so that people are a lot clearer about where they need to be in this whole thing. Now, it's you spoke about corporates and kind of when I think about it, we've actually been at it for a while now. So while this whole talk about stakeholder capitalism, sustainability, etc., is relatively new, you go back to sometime in 2011 or thereabouts, 2010, 2011, about, which is almost a decade ago. Following the UN Global Compact, the Ministry of Corporate Affairs actually came up with what they then called the NVGs, or what we now refer to as NVGs, but they called the National Voluntary Guidelines on Social, Environment, and Economic Responsibility of the Business. And these were on the 9 broad business principles, some of which have been touched upon in terms of rural development, livelihoods, and so on and so forth. And what does it mean for companies? And that companies kind of translated into what was then called the business responsibility reporting, and companies needed to report on these 9 aspects. You kind of fast forward a little bit, you then had the global rollout of the SDGs. The Companies Act actually spoke about the fact that business needs to focus not just on shareholders, but also on all stakeholders. And again, that had kind of started to enter the discourse. They also at some stage made the BRR reporting mandatory for the top 500 companies. But more importantly, with the new Companies Act, with the SDGs, with the greater thrust on green, all things green, there was this shift from what we would call the NVGs to the national guidelines to what is called NGRBC. I'm sorry, I'm using a lot of abbreviations, but that's what's done here. So, which is translates into the national guidelines on responsible business conduct. So that was a big change. The other change was that, all this was reported earlier through the BRR, and this is now being reported through what is called the BRSR, or the Business Responsibility and Sustainability Reporting. Now, the government or the SEBI's given companies a transition time, and till this year, companies, when they closed financial year 22, they would report on the BRR, but 23, when they report their financial reports, they will be giving the BRSR reporting. So therefore, there is going to be a lot of information which is going to be out there for people to start kind of collating and looking at it. Now, one of the things, the reason I kind of focus on this is that, at the moment, and this is something which was touched upon a little bit earlier by Paul, as well as by Silvia, that look, people do say that, look, we don't know what is it that we are looking for, etc., etc. So this is the first step in terms of the data is going to be available. Over a period of time, you get cross-section data, you will get intertemporal data, and therefore there will be a meaningful comparison which investors will be able to do, which becomes pretty useful for them. As far as, so therefore, I do believe that given the regulatory thrust as well as the demand which investors have, there is going to be some move towards, at least on the reporting side. The business itself will kind of go through its own struggles, if I may say so, because one is the fact that, if we do talk about, let's say, something like coal, if you kind of take a hard look at the Indian economy and its energy needs, even today, more than 50% of our energy needs are met by coal. So if we need to wean away from coal and look at other options, then it's not going to be in a hurry. And therefore, there has to be some focus on transition. And which brings me to how the investors kind of start looking at these things. They kind of say that, okay, we will go in, but we'll start looking at the delta, which is there. Again, I guess from the investor perspective, and also to some extent from the corporate perspective, what they're all kind of struggling with is what are the trade-offs at this stage. And we need to remember that, we talk about E, S, and G, and they've all been kind of put together. But if you kind of take a hard look, I know Paul kind of threaded them together very well. But at one level, the three don't sit together so well. So there could be trade-offs in terms of companies who are doing, pretty well on some aspects of the environment, but there are issues with regard to what they're doing with the broader set of stakeholders. And therefore, how do you kind of balance these two? Which brings you to the bigger question in terms of, are you looking at impact of something like sustainability or ESG, or are you looking at it as a way for a capital allocation decision? But I'll kind of just end with what I started, which is to say that, look, if they're all, everyone's circling to land, what everyone wants is a fairly simple document and a simple way to understand in terms of what is considered green, what is considered socially acceptable, and what is good governance. So if we are able to address that challenge, we are going to be in a much, much better place. Back to you, Vidhu.
Thanks, Amit. I remember on a lighter note, Silvia, you wrote an article recently in which you compared you wrote about the ISSB, the Sustainability New International Sustainability Standards Board, and you compared that with the UK food menu calorie. You have to write how many calories your food menu has. So does it? I mean, we have a very complex landscape of disclosures and standards. Though it's now all coming together. You have the SASB, you have first you had the Value Reporting Foundation with the IIRC and SASB, and then CDSB came together with that, and then you created IISB. You still have GRI outside of this, and you have TCFD, which is what is driving climate-related disclosures and so on. And then we heard both from Paul as well as Nick, Paul as well as Amit, that there are issues about how these disclosures are happening in different parts of the world. Can you talk a little bit more about this and the problems that it's creating, or the problems that it is solving right now? Because we seem to be at a place where things are all changing very quickly.
Absolutely. And of course, one of the themes that I think everyone here has been talking about is data and definitions. So we're starved for data. There isn't much data. There are lots of estimates and lots of data providers that give you those estimates. And so we're kind of all guessing. And Paul rightly mentioned that although there are many ESG funds, most of them are passive, and therefore it's all kind of automated. The real difference can be done by active investors, but obviously that's a different kind of game, and not everyone can afford to invest through an active investor. Transition also very important, because there is a big question mark on that, but we can obviously touch on that later. And to your point of disclosure framework, so this is the infrastructure through which we're going to channel data from companies to investors, to regulators, to the public even. And yes, the alphabet soup, as we mentioned, of reporting standards and frameworks is phenomenal. You rightly pointed out to the fact that there is a trend towards consolidating. There is a realization that there are too many of these frameworks. And again, when things are new, everyone tries to come up with their own solutions. And then you realize, hang on a second, we're making things too complicated. Let's come together. And so there is great expectation about what the ISSB, the International Sustainability Standards Board, will come up with, because the ISSB is an initiative of the International Accounting Standards Center, the IFRS Foundation. And their objective is to put together building blocks that they hope will be easily adaptable and incorporated into different jurisdictions, the requirements. The ISSB now includes the Value Reporting Foundations, as you said, which even before started this sort of incorporation or consolidation rather exercise. So the ISSB, which is the reporting framework that some of you may be familiar with, that was created in the States and created specifically with investors in mind. So they only look at the factors, the ESG factors that have a repercussion on companies. They don't quite care about the company's repercussion on the world and on the outside world, and it's broken down by industry. So that's now part of the ISSB. There are also a number of other reporting frameworks that were looking at, again, ESG from different points of view. The GRI is the one that looks more broadly at companies' footprint, I guess, on the world. So it's more outward looking, and that's perhaps more for stakeholders. And TSFD, as you said, is the one that looks at climate-related financial risks, and it's more of a sort of an indication, a framework, very much so, of what company could do. And it's the one that perhaps is most widely cited by regulators. So the ISSB also mentioned it. Under European regulation, the mention to basically, the first rules were saying you choose whichever reporting framework you want, as long as you use one of the established ones. TSFD was one of them. The US also, the Securities and Exchange Commission is also referring to TSFD in their exploratory work around creating climate disclosures, which, as we know, I mean, that's a we're opening a whole Pandora box over there, because we know that ESG is highly politicized in the States, and therefore there's been quite a lot of back and forth and pushback, and then pushback against the pushback when it comes to climate and ESG. But we can talk about that if you wish later. So what Europe is doing, in addition to all of this, the European Commission is also looking at its own reporting framework, separate from what the ISSB is working on. And anyone that is captured under EU jurisdiction, is based in the EU essentially, will need to report using that framework which the EU is putting together. The big differences between these two, and it's something worth considering and mentioning now, because it's something that lots of people are talking, both regulators and investors, is whether these reporting frameworks should look at the so-called double materiality, which means you consider both the impact of the environment and more broadly ESG factors on your company. So those ESG factors and those risks, are they going to make a difference to your bottom line? And you also need to report on your impact as a company on the world. So that's the approach of the European Union. ISSB has taken a more investor, I guess, led approach, and so they look at what is called the financial materiality, investor materiality, and they only consider, as far as we know now, though of course this is all work in progress, the impact of those ESG factors on companies. So there is a lot of discussion around that. Now, the trend is, and the talk of the realization that there are too many of these frameworks out there is positive, because then people are talking about this, but you you also have the ones who say that, well, actually, I don't want to be told exactly in such a strict way what I need and do not need to do, because I operate in this market and the rules of the game are different in their markets. Let me be. So it's very much work in progress, and it's a very confusing area, isn't it? It's a very confusing area for everyone. So lots of work, the other thing to say is that because of policymakers work around this and their attempt to include and involve and talk with the industry as much as possible, everyone is feeling a little bit fatigued. So there are so many of these proposals and so many of these requests for feedback that, you speak to some asset managers, they don't even know where to start. It's like, it's too much. It's becoming someone's full-time job to actually put together feedback to these proposals. So even that in and of itself just tells you the challenge around reporting this kind of data. And we talked about the importance of just having one definition. I think that is kind of impossible, isn't it? Because of course we can look at CO2 emissions, but then CO2 emissions in and of themselves, they do not tell you much, because it depends on which industry you're in. It depends on whether you actually have a good transition plan to decarbonize your activities, and how do you incorporate that information. I was talking to a pension fund advisor based in the UK, and she was telling me that actually there isn't anything that would help her advise her clients, pension fund clients, on what to do when it comes to transition, because there isn't anything that actually helps distill that kind of information in a metric that would allow you to make a quick decision. So it's very complex, and I'm not sure we can actually all agree on what is green. And again, I'm talking too much about this perhaps, but it's I don't want to take too much time from the other participants. But back to the taxonomy, we have seen that the EU, which was really quick off the blocks in creating a definition of what is green, had to soften its stance, because initially it was no gas, absolutely no nuclear power, and now we are including them within the taxonomy as transition fuels because of a variety of reasons. And you have others around the world that are taking a similar approach. So yes, definitions, I suspect, will remain not too fixed, that there will be many shades of green, I think.
Thanks, Silvia. I mean, for me, as you were speaking, a couple of thoughts came to my mind. One is that for anybody who is watching today, by now you know that how complicated this field is, and before you start really understanding anything, you need to understand the science behind a lot of the sustainability issues, the climate science and science behind the other sustainability problems. You have to understand the issues related to political economy, right? Subsidies and which parts of the society are affected, how justice, and so on and so forth. You need to understand the science behind renewable energy and so on and so forth. So there are many things you need to understand, all these frameworks and all the institutions that are involved. So I think you need to basically put in a lot of effort before you could really say that, okay, now I can think clearly about sustainability and sustainable finance. So just I want to leave that as a comment from my side. And I want to move now. We are, we are coming to the close of our discussion to some of the larger issues. One particular issue is climate justice. Okay, so if you take the example of a company like Coal India Limited, okay, it's a coal company, and it has got around 250,000 employees. And say you take the EU taxonomy, which says no fossil fuels, and you are dragging everybody off to renewables. What happens to these 250,000 employees, right? Who does this, the fossil assets are going to get stranded. How do you deal with those issues? Paul, I want to come back to you and ask you first about what you think about some of these larger issues, how you have come across these things when in your own work. And then I want to go to Amit also, because this has been a live issue here in India.
Well, thanks, Vidhu. I don't think you should ask a British person about the closure of mining industries, Vidhu, because our track record in that is not very glorious, and we live 40 years on with the challenges that closing our own mining industry down in the early 80s are still with us. The bitterness, the unhappiness in certain communities, the pockets of poverty that created are still there. Obviously now it's for different reasons, but the end result is going to be the same, that we will migrate out of fossil fuels to other fuels, and those jobs will be created in other sectors of the economy, but the transition as it happens will be extremely painful on a personal and a community level, and there's no question about that. So in terms of climate justice, how does the world, I mentioned the stat earlier on that Africa is the country that gives me, or country, it's a stupid thing to say, Africa is the continent that gives me most pause for concern when I think about climate justice, particularly. How are we going to, as a developed world, how are we going to assist the developing world away from fossil fuels into other areas? South Africa has exactly the same problem that India does. And I don't think there's any alternative other than for financial subsidization from the rich world to the poor world, either via carbon taxation or through other methods. But to expect relatively poor countries to migrate away from fossil fuels is naive. I think you've got the starts of some ideas on this when you look at what's happening in Brazil with the Amazon rainforest and the subsidies that the Americans particularly are beginning to put into Brazil to stop the rainforest from being chopped down at such an aggressive rate. So there's thinking about this. The concern is obviously that the world, you can take two views. The world's supranational bodies are not really functioning at the moment, and these solutions have to be provided on a global basis as opposed to on a local basis. And right here, right now, I think there is a lack of global political harmony that enables these challenges to be met successfully. Having said all of that, I'm not that negative in that I think, when you look at things like the pandemic, for instance, I was arguing with someone the other day. I mean, I think the global response to the pandemic was a pass mark. I mean, I wouldn't put it more than 6 out of 10, but I think it was a pass mark in terms of getting vaccines into the hands of the poorer nations. It was slow, it was inefficient, but we got there in the end. I kind of think that's a useful blueprint to help the global coordination of what needs to happen for climate justice to be properly smoothed out. The biggest challenge, I think, is that this isn't a conversation that's really had, in my hearing anyway, in the Western world and the developed world. It's not so. I think it comes louder from the developing nations than it does from the developed world at the moment. And that bothers me because ultimately it's got to be a transfer of wealth from the rich to the relatively poorer. And I'm not sure wealthy nations have really woken up or accepted their responsibilities as far as that's concerned yet. So.
Can I quickly add something? Sorry, I don't mean to interrupt still again too much time, but this is such an important point, and just something I would like to mention is that Janet Yellen, the US Secretary and Treasury Secretary, actually just mentioned right before the beginning of the annual meetings of the IMF and World Bank that there is a need to have a big change of multilateral institutions because of these reasons, because there is a need to actually get them to act more forcefully or with greater impact around themes on to do with climate. And many people have been calling for the use of blended finance or other tools so that these multilateral development banks actually act as catalysts for private sector capital. That's a whole different area that would deserve another webinar perhaps. But you're absolutely right, Paul, and something very important to look at are the data that shows this yawning climate finance gap in Africa. We've actually written about the sustainable views. We did a long piece on this because it's such an important issue. And with COP27 taking place in Egypt, lots of people have expectations that it will be the Africa COP, and let's hope that actually good solutions and commitments are going to come out of that, and then action will actually follow.
Thanks,
So,
Silvia.
Vidhu, just let me add something. I mean, I kind of agree with what both Silvia and Paul said. I guess the way which is being addressed here is to kind of say that our commitment is there to the Paris Agreement, but we're kind of postponing it by a couple of years. So that, buys you time. So that a lot can happen. One is, the world gets together in terms of how the funds move from the richer countries to those who need it. Maybe there's time for newer technologies. Maybe there's time for things like carbon trading, etc., to take on, so that there is money which goes from one to the other. So there are a lot of things which can happen the moment you buy a little bit of time, and that's what has been the thrust of our negotiations, in part by saying that, look, we are committed, but not on the timelines which are demanded by some of the more developed countries, but those which would be more keeping in mind our socioeconomic realities.
Yeah, but okay, can you talk, Amit, about what's specifically happening in India with portfolio flows? And for instance, we saw that there was an issue with certain funds investing in State Bank of India because they had an exposure to Coal India and things like that.
Yeah, but look, a couple of things. I know there was a lot of data which was given with regard to ESG funds. We know that there's a huge number of them in Europe, and Paul alluded to those, and them in China and some of the others. India, doesn't have very many ESG funds. When we looked at the data, our sense was that it's going to be around $2 billion. So it's not very significant. And again, to borrow an expression which was used, a lot of them were intentionally intending to be ESG funds because they had investments in power, coal, and so on and so forth. I think the controversy, some of these which you refer to, tend to be a little bit episodic because, some fund will wake up and say that, look, State Bank of India has invested in a company which has kind of got, supplying to the defense establishment. Then when you kind of start digging a little bit deeper, what they're doing is they're kind of making trucks, which are then getting modified and used for defense. So I think, therefore, we have to be a little bit clear. Some of these do attract the headlines, but and I'm not taking away from the fact that there is the genuineness of some of these, but a lot of it is just based on incomplete information, which then kind of gets blown out of proportion. But having said so, we need to recognize that, if you kind of look at the global investors, they're a lot mindful about some of these. They're very sensitive to about some of these concerns. And if we are looking for capital, which we are at all times, we need to be sensitive to the fact that, look, what is it that their expectations are? We can actually also add to it that, look, this is where you are, this is what where we stand, and therefore make a stronger user case for why we are doing what we are doing. But it doesn't, I'm not for a moment saying that we should just ignore what some of the demands on corporates are today.
Thanks. So, we are at the hour right now, and I just wanted to check the pulse to see if we are feeling optimistic or not very optimistic with all the discussions that we have had. Because, there is a wide spectrum of people's beliefs when it comes to sustainability. There are those on the right who think that all this is really, really not needed, and perhaps some of the discussion on sustainability is going to slow down the economic growth and make people in the developing world worse off. And there are people on the other side who say that whatever we are doing is like rearranging deck chairs on the Titanic. because it is all built into the global asset management capitalism, and no one's really interested in doing anything as long as they can, they can go through the motions and make commitments and things like that. Paul, where do you stand on this? Especially, so if you take a question like, can you direct sustainable finance towards some of these transition and climate justice issues that we discussed before in the panel? Do you feel optimistic as this is a force for good?
Well, I think the classic definition of an asset manager, of which I'm one, is a professional optimist. Basically, we manage your money until it's all gone, Vidhu, as you know, and that's our mantra in life. I'm very optimistic. I think the piece that Amit touched upon it really, the piece that we sort of underestimate is the boost to global growth that transition economics will provide, basically. Goes slightly to your climate justice point as well, that a lot of the analysis that I read anyway shows that as we change from older technologies to new technologies, as solar power, as battery storage comes online and improves, the boost to the global economy that those will give is really quite striking, and will help suck more capital in behind it. And I think that's the piece that we're part way through at the moment, but we haven't really seen enough of, because the sustainability conversation has come from a risk management place and a sort of negative place, if I can put it that way, the avoidance of doom. We haven't looked enough at it from a positive perspective. How does this challenge actually promote global growth and make ourselves more secure and safe in the future? And I'm an optimist that those technologies are appearing, that the solutions are there, and that capital eventually will be deployed properly. The climate warriors obviously tell you that it's not going to happen in time and all of that, and they may be right. But I think there's a number of sort of transition things that occur in the meanwhile that, again, are very difficult to model. I was looking at a British bank today, oddly enough, that's doing a lot of intermediate lending for people to lag their houses better, for insulation, to change boilers, to do all of these things where we waste so much energy at the moment in the world. And we haven't really factored in, well, what would happen if we were able to save 10% of our current energy usage just by living a little more sensibly? And we're now having to be forced to do that because the price of gas and electricity is going through the roof, and all of a sudden people are wearing a sweater at home in the winter. Shock horror. That was the way I was brought up when I was 60 years ago. You didn't turn the central heating on, you put more clothes on, and all of a sudden we're discovering that these old solutions still apply. And I think we have many more levers than we think, and the technologies are coming quicker than we think. And I'm an optimist that the solutions are at hand.
What about you, Silvia?
So it's good to be optimist, I think, and I want to try and be one. Although journalists tend to gravitate more closely to cynicism, perhaps. But it's true there are so many interesting technologies out there, not just the ones that have really proven their worth, like renewable energy, but there's so many other solutions. Portable batteries that they can also they can charge your car, but also being used as a generator for a small house. I mean, those kind of things, just so exciting. And it is true that ESG actually, as a definition, was really attached to risk, as Paul rightly said. So it would definitely be interesting to keep on focusing on the positives, on the growth prospects of looking at what these new technologies can bring to portfolios. And I know that a number of portfolio managers very closely monitor this and have heavily invested in actually go out and search for companies that provide these new solutions, very niche and very specific, but with really high potential. It is also true that we as people can, modify our behavior. And like you, Paul, I come from the same, grew up in Italy. My parents are baby boomers, and we were told if it's cold, you put on a jumper. Exactly the same. So that's fine. But I think it would also be a little bit unfair to expect consumers to do the heavy lifting. And I think that perhaps greater pressure should be put on governments and policymakers to act. And there is a lot to be said about lobbying, what corporate lobbying does to sustainability, and lobbying rules. And I know that, of course, again, policymakers are looking at this as well. And ultimately, I mean, I hope that we as a species are ingenious enough and not too silly to actually stop digging when the hole is too deep. And we have seen the big change of living in different kind of lifestyle, as Paul pointed out during the various lockdowns, what that did to us, and that was such a huge catalytic to, for example, think about what's possible. So business travel, maybe you don't need to be on a plane constantly to go and meet people on the other side of the world when this technology actually works fine. And of course, there is a lot to be said about human interaction. Of course, that's fine. But for many other activities, we can do them perhaps online. And the same again with the other ways in which we live our lives and how more responsible we are in our choices of consumer products and suppliers. So yes, I also want to be optimistic, but I think that a lot of work needs to be done by policymakers, and it would be a little bit unfair to expect even asset managers or consumers to do the heavy lifting.
Thanks, Silvia. Amit, optimistic, pessimistic, cynical?
I'm kind of in the optimistic camp, but having said so, I do recognize that we'll kind of muddle through to finding a solution. That's because there'll be 2 steps forward, 1 step back. And that's because, my sense is that this whole notion of ESG and sustainability is very fuzzy. And as long as we kind of come to recognize the messy reality of ESG, we will find a way out of what the direction we seem to be heading in a few years ago. So I'd sum up saying I'm optimistic.
Thanks. So we are out of time right now. So I think that's a good note, 2 optimists and 1 cynical. So, and we haven't even discussed greenwashing yet. So maybe that will change some votes. But we have more webinars to do with Tirthankar. So maybe we can discuss some of these specific topics, pick them up and analyze them in subsequent webinars. Thank you, everyone. And back to Tirthankar.
Thank you. Thanks, everyone. I mean, it's not often, discussions on ESG these days go one of either 2 ways, meaning are we woke, what is happening, what needs to be done, and what are the regulators doing? I think towards the latter part of the discussion, when I was hearing you all, I mean, it made one take a step back and think. There is a room for taking this seriously. There is room for optimism while recognizing that there is a role for people, but governments as well. I think Silvia's point is very well taken, that you should not really expect people to do the heavy lifting. Yeah, we can wear sweaters in the winter, Paul. I entirely agree. But if things could be better in from the government's perspective, or things could be done along those lines, we could go a long way. Thank you, everyone, for a really insightful discussion. I mean, my thanks to Vidhu Shekhar, Silvia Pavoni, Paul Smith, and Amit Tandon. Thank you all. We had over 250 participants in the webinar this time, and it's really good to hear you all. Thank you. Thanks a lot. Have a nice day, everyone. Thank you.
Thanks. Bye.
Thank you.
Thank you.
समझ कर इन्वेस्ट कर।
NSE द्वारा निवेशकों के हित में जारी।